Welcome to Market Call. I'm Paul Bagnall. Gordon Reid is on our show today. He's president and CEO of Goodreid Investment Counsel. Of course, he will take your questions on U.S. stocks. So get ready to call us toll-free. In fact, pick up your phone and do it right now. 1-855-326-6266 is the phone number. You can also email us at marketcall@bnnbloomberg.ca. Let's welcome Gordon Reid to the program. Gordon, thanks a lot for coming by. Always great to have you here. Okay, your take on the U.S. economy. We got some inflation numbers today, and perhaps more to the point, the U.S. market.
Yeah, well, the U.S. economy is in fairly good shape. I think that if you look at the labor market, it looks quite constructive. Certainly, we have some lingering inflation and I think impending inflation with some of the tariff impact still yet to hit. Longer term, however, Paul, I'm quite constructive. I see AI as being a real deflationary trend over a long period of time. And I think that the tariff issue will be episodic as opposed to, a longer term, more secular effect of AI. It being very disruptive. It'll have many, many impacts, some positive, some negative, but on inflation, I think it'll be a positive impact.
What is your view of valuations in the market? When indices are at record highs, it's often common to hear people express concern about where stocks are from a valuation point of view.
Sure. I think without question, markets are fully valued. That doesn't mean that markets can't go up, because markets go up on two ways. One is an expansion of multiples, greater expectation of future earnings, and the other is organic growth. So if you find companies that are growing at 2x, 3x, 4x of GDP, you have an opportunity to grow organically, and that gives you a leg up. Coming into this year, Paul, those who read our Goodreid gauge, which every quarter we post on Goodreid.com and anybody can see it. In fact, we just posted it a few days ago for this last quarter, knows that coming into this quarter, we said, well, we just had two fantastic performance years in the U.S. equity markets. What we expect and what we would like to see for 2025 is a more normal year.
Yeah.
And a normal year is about 8%. Well, here we are. We're up about 6% halfway through the year, pretty much in line. But we also said expect volatility. Probably we didn't quite envision what happened in April, but that's volatility for you. The effect of volatility, the impact of volatility is to knock your socks off a little bit. And that's, I think, what April did. But we're in a good place, and just sort of steady sailing.
What will you be listening for on the conference calls when you hear corporate executives provide their analysis of their business, the economy, and their outlook?
Well, last quarter they got a very strange pass. Like, nobody really held their feet to the fire. They said, well, with tariffs, we just don't know what's happening, so we're pulling guidance, or we can't really tell you what the future will hold. Normally, that would be highly negatively impactful to a company's stock price. It just wasn't, because everybody said, well, of course they can't tell. This quarter is going to be different, and people will want to know what the expectation is for companies, and I think we'll see some kind of a bifurcation within the market of the haves and have-nots. And of course, you go through any earnings season, any portfolio manager will tell you, you're really trying to avoid the landmines, the I was wrong situations. And last quarter we were quite positive. We had a very good earnings quarter, and we're hopeful for this year, this quarter as well. Started off with the banks. Some of them this morning, pretty constructive. Prices a little bit muted, but they'd run up coming into the earnings.
That's Gordon Reid, his take on the U.S. economy and the U.S. markets. We'll be back with Gordon right after this short break. He will begin taking your questions on U.S. stocks. Okay, let's start the questions coming to Gordon Reid. Our viewer Alan has written us an email. Here it is. What is Gordon's opinion on IBM as a long-term hold? Is this a good entry point?
My answer at this point would be no. We've been owners of IBM in the past. We saw an opportunity maybe 18 months ago, 2 years ago, when the stock was in the 180 level, I'd say, 175, 180. And what we saw was that the market was pretty much ignoring the AI aspect of IBM's business. They saw a low growth situation and said, well, this is sort of just going to persist. And we took advantage of that. We bought it. They had teamed up with Meta and used Llama to enhance their Watson franchise, and it worked quite well. We made a good amount of money on behalf of our clients. But then what we started to see was that story getting into the market, multiple moving into the low to mid 20s, and at the same time saw some of the consulting competitors of IBM, Accenture, for example, reporting sort of tepid results, and we decided to exit. So we exited the stock, and at this point wouldn't re-enter.
Okay, thanks for the question, Alan. Let's go to the phones for the first time in this show. John in London is our guest. John, thanks a lot for your call. What's your question to Gordon Reid?
Thank you, Paul, and thank you also, Gordon, for all the excellent advice you've given over the years. You probably comprise a quarter of my portfolio at this point. Two of the more recent ones, Uber has done very well, and Dycom, you recommended on the last trip in.
Yeah.
And I picked it up about 2.25, and I think it's up about 2.55 last time I checked. Thanks very much for Dycom, and I wonder if you could apply your principle about expansion of earnings and organic growth. Thanks very much.
Yeah, Dycom is an interesting situation. It's you have to understand the company. It's a company that has relatively few very large customers, almost all of them in the telecom business, the big telecom companies, AT&T, Verizon, but also cable companies, Comcast, and right over to Google, for example. And the business of Dycom is that they are laying cable, fiber optics, throughout North America to bring 1 gigabit capability speed to rural America, to get them wired up. Amazingly, much of North America really doesn't have very good connectivity at all. And the infrastructure bill of a couple of years ago carved out about $40 billion to bring that communication to rural America. Dycom is getting a lot of that. So it's done very well. They've got a big backlog, about 18-month backlog against sales. But on the riskier side, if any one of those large companies defers, if you have bad weather, the sales and results get quite lumpy, and markets can be reactive. So you have to take that into account, almost see through a lot of the noise to get to your end result.
Okay, thanks for the question on Dycom. Let's go to Joe in Montreal. He's our next caller. Joe, thanks for your call.
Thank you, Paul. I wanted to ask your guest about Bank of America. I'm retired. It's in my non-registered account. Have a good capital gain on it. What effects will, when this tariff situation finally come and be completed, will it have any significant effect on whether somebody should hold on to their Bank of America, where they're near their highs for the last couple of years? Should they take some gains off the table here, or should they just hold on for a brighter and higher future? Thank you.
Well, I'd say, Joe, that specifically Bank of America is not really affected. In the broader sense, if the tariffs were to have a very impactful negative effect on the economy, yes, I mean, the banks would be affected, but I don't anticipate that. I think that Bank of America is pretty much insulated from the effects of tariffs. They report tomorrow. We expect good numbers. If you take any indications of the banks that reported today, being JP Morgan, Citi, and Wells Fargo, net interest income is improving, and both JP Morgan and Citi either beat or raised to the high end of their guidance. the expectations for net interest income. That's good for Bank of America. They are very sensitive to that. And I think that's going to be a real driver for the money center banks in the last half of the year, one of them anyway.
Okay. Thank you, Joe, for your call on Bank of America. Let's go back to the email inbox. Frank is our viewer who has sent us an email. Any thoughts on Ford Motor?
Yeah, we own GM in our U.S. large cap portfolio and obviously do peer group analysis. And Ford really, unfortunately, just doesn't compare. If you go back 3 years, Ford is basically flat. It might be marginally up. The S&P is up 65%. GM is up 68%. So it really hasn't participated. It is probably in a better position vis-a-vis the tariffs than some of the other automakers because I think close to 80% of their production is domestic. But the offset to that is the fact that their production is expensive. And that's, of course, the whole argument, isn't it? That the reason for globalization was to have input costs be reduced. To manufacture domestically in the United States is going to be more expensive. You just have to look at gross margins and operating margins for Ford are roughly 10%, and they're probably 50% higher for GM. So that sort of tells the story.
That's Gordon Reid, and the first batch of questions to Gordon. We'll be back with Gordon right after this. Of course, he will continue taking your questions on U.S. stocks. Okay, let's keep the questions coming to Gordon Reid. Our viewer Greg has written us a message. May I have your guest's long-term opinion on Uber? Another caller has referenced this stock, and you've talked about it in the past. I was telling you over the break that on a fairly recent episode of Market Call, a couple months ago, perhaps you referred to it as maybe one of the most mispriced stocks in the U.S. stock market. Yeah,
and I think it's starting to see clearer air, and I'll explain that. There was a feeling at one point that Uber's destiny was really binary. If Tesla was successful in the autonomous vehicle program and there are a lot of driverless cars on the road, then Uber was out of business. And our argument was, no, that's unlikely to happen. It's going to be a hybrid solution. Uber is not standing still. In fact, right now, Uber's got close to 20% of its fleet being autonomous vehicles. They're planning for a future of at least partly driverless vehicles. In fact, 2 months ago or 3 months ago, when I made that statement, Paul, I wrote a blog, and I posted it on our website, so it's still available for people to read at Goodreid.com under Articles and Insights. You can go in and just click on it and see a lot of other content as well. The point I made there was that Uber's valuation is coming back, like they're outgrowing their valuation. So the valuation is dropping with higher fundamental results. And it's becoming much more mainstream. Not that long ago, they were made part of the S&P 500. And this is a company that has a fantastic future. It's going to be a part of our, well, it's already part of our lexicon, isn't it? It's both a noun and a verb.
Yeah, I'm going to Uber somewhere.
Yeah, I'm going to Uber somewhere. I'm going to grab an Uber. So it's really a great company and well managed. And go ahead and get into that blog, and you'll get a lot more factual information. But we're very, very positive on it.
Okay, that's a blog on Goodreid.com, correct?
Correct, under Articles and Insights.
Articles and Insights.
Yeah.
Okay, thank you for the question on Uber. Let's go to Dominic in Montreal. Dominic, thank you very much for your call.
Yes, hello, Paul and Gordon. Thanks for taking my call. I own 4 of the mega cap stocks right now, and I have some cash to deploy. And I would deploy on any one of these 4, but I would be dollar cost averaging up at this point. Everything is kind of expensive. I'm considering increasing my weight on Google. I wonder, Alphabet, at these valuations, Gordon, if you see better growth /value from other mega caps, and what part of Alphabet do you see driving the stock price from here?
Yeah, good question. I don't know the composition of your portfolio, Dominic, but make sure that you have enough diversification and enough diversification away from the Mag 7 to give you a little bit of a value bent as well. You don't want to fall into the trap of starting off as a value/growth investor, go to a growth investor because the market takes you there, and then all of a sudden, when people look at your portfolio, you're defined as a momentum investor. That's something that you have to watch, and you have to make sure that you're true to your disciplines. So don't forget the other 493 stocks out there that make up the 500 and the S&P 500 outside of the 7 that make up the Magnificent 7. Specifically on Alphabet, I like your question on what part of Alphabet really is going to drive things. A lot of words have been spent on what's negative about it, and that is that search, which they control 92-93% of in the world that we're coming out of, is going to be diluted by AI. And there's no question that is going to happen. But are we going to see a bigger pie story? So are we going to see a much larger total addressable market, and Google will have a smaller percentage of it, but still grow in absolute terms? And I think that's as much likely as any other scenario. So search or their version of AI, being Gemini, will dominate, but there's other parts to Alphabet that are very, very exciting. One of them we talked about a little bit earlier in autonomous vehicles. They've got Waymo. And in fact, what I didn't mention when I talked about Uber is that Uber and Waymo have a strategic partnership testing out autonomous vehicles, and there's nothing but growth there. So that's a very big opportunity for them. But you also have to look at the streaming world and YouTube. And YouTube is the largest streaming piece of television. I read an article just this morning that was saying that within the television world, according to Nielsen, 46% of viewership comes out of streaming. So they're just pushing past that break-even point. Streaming will be dominant going forward. And within that 46%, YouTube is the largest, bigger than Netflix,
Wow.
bigger than Disney,
Wow.
by a pretty big piece. They controlled, I think it was 12.8%, and Netflix was 8.3%. To put things in perspective, Disney was about 4%, 4 and change. So YouTube is a very, very big franchise and an opportunity for Alphabet.
That is Gordon Reid and the most recent batch of questions. We'll be back with Gordon right after this. He'll continue taking your questions on U.S. stocks. He's Chief Investment Officer and CEO at Goodreid Investment Counsel. Okay, let's keep the questions coming to Gordon Reid on U.S. stocks. Jeff is in St. Paul, Minnesota, and he's on the line right now. We're on past picks, I'm sorry. We are going to have to scroll back. Okay, we're going to go back to past picks. Here we go. We are going to revisit July the 16th of 2024, about a year ago. In other words, here is a past pick from Gordon. It was one of the 3 on that day. Amazon, I won't repeat the numbers to you, except to say that it has been a total return of 17% over that period of time.
Yeah, Amazon is getting its feet under it. They had a period after COVID where there was a little bit of a mismatch between the capital that they'd put into the business and the results that they were getting. Not uncommon to a lot of big companies. But on all fronts, whether it's AWS, where they're now back in a growth mode, their AI franchise is taking share and doing well. And their e-commerce business is just humming along and getting more and more efficient and effective and more of our lives, quite frankly. So very, very positive on Amazon. Similar to Uber, they're growing into their numbers. There was a point where They were trading at a very high multiple. They were really managing that because their expenditures were discretionary and they were investing for the future. They're now allowing some of that to filter down into earnings and becoming a little bit more mainstream from that standpoint for a very large company. We own it, we like it, and highly recommend it.
Okay. Number 2 on that day, NASDAQ Incorporated. This is not a ETF that tracks the NASDAQ. This is the company that runs the exchange and provides exchange services. Total return over the past year, 44%.
Yeah, as we thought a year ago, we were at the bottom of a trough of capital markets business, and of course, as an exchange, they like IPOs, they like capital markets, and this year, IPOs compared to last year, there were 13 so far in the first half of 2024 last year. This year, 61. So, and in 2025, they've already covered 75% of the total volume of IPOs that they did in the first half. So well ahead of last year. The other side of it is that this is a company that's investing in technology. So a lot of the new listings are coming to NASDAQ because they offer, a higher level of technology, of service to new companies, and they're getting a lot of the flow in competition to the NYSE.
Okay, and banks are in focus today. Here's one that did not report results today, but will before too long. Morgan Stanley, total return over the past year, 40%.
Well, this is a company, a bank that has remade itself over the last quarter of a century. You know, a generation ago, it was known as an institutional house, primarily fixed income, capital markets. Now, 50% of their business is out of the wealth management side. Starting in, I think, 2009, they did a joint venture with Citi and assumed Smith Barney, and have added E-Trade, they've added Eaton Vance. So a lot of their business now is wealth management, but they also have, a toe in the water with respect to the capital markets, which I just talked about with NASDAQ, a growing area. We think we're going to hear a lot about capital markets growth, and we're going to see a lot of deals in the second half of the year. We're already seeing some evidence of that, but with all of the angst in the marketplace, smaller companies have been hesitant to go public, to do capital markets business, and bigger companies are really dominating there. We think that'll flip around. Finally, we're starting to see it in our own portfolios. In our U.S. small cap portfolio, which has 34 names, we've already seen 3 takeovers in 2025, which of course is very additive, but it also is indicative.
That is Gordon Reid and his look back at 3 top picks, all with double-digit gains over the past 52 weeks or so. Those picks, again, about a year ago, were Amazon.com, NASDAQ Incorporated, and Morgan Stanley. We will take another break, and then we'll get back to your questions on U.S. stocks. We will get to our caller, Jeff, in St. Paul, Minnesota. Thanks for hanging on, Jeff. We're going to get to your call in just a second. Okay, now we're going to get to Jeff in St. Paul, Minnesota. Jeff, thanks a lot. It's taken us a while to get to your call. Thank you very much for hanging on the line. You're on the air now with Gordon Reid. What's your question?
Hey, triple intro. Thanks. Congrats to you on your retirement announcement. We are going to miss you going forward.
Thank you.
Maybe you'll come back as a special treat to guest host when Morella gets a break. Gordon, Mr. Reid, always appreciate when you're on. Always get an action item or two every show you're here. So thank you for your time and expertise. I'm wondering how Intel looks to you going forward, what you think of this stock. I'll hang up and listen. Thank you very much.
Thanks, Jeff.
There's lots of exciting opportunities in that space. And, when you make choices, you, of course, fill up certain sectors or industries. And Intel is one of those companies that really has missed the mark over a long period of time. They haven't reached objectives. They haven't hit time objectives. The C-suite has been a revolving door, which is of course concerning. So even though there's a possibility that Intel could, suddenly come up to bat and hit a home run, and it would be very positive for the stock, that's not really the way we want to approach the market. We like companies that have demonstrated a level of outperformance, created a moat, differential, and then buy them at attractive prices. And Intel just doesn't fit that bill.
Okay, thanks, Jeff, for your question on Intel. Michelle is in Miami. Michelle, thank you very much for your call from Miami. This is Miami, Florida, I assume. Is it, Michelle?
Yes, that's correct. Thank you very much for taking my call. I'm curious about the large pharma stock, but mainly Pfizer at the moment. I like the dividend. It seems like they have a lot of potential for the future, 3-5 years. But I know they have a lot of pressure right now with the tariff today, 2.5 down. So what's your opinion, and do you think they should replace the CEO in that group?
Yeah, well, just talked about Intel, and I would echo some of those comments with Pfizer and some of the other big pharmas. Big pharma has had problems for many, many years, and the problem is really foundational. And that is that they spend billions of dollars developing new drugs and new technologies, medical technologies, and then based on current law, they go over that patent cliff. And patent law, current patent law, dates back for the pharmaceuticals, dates back to the mid-1980s. You have a certain period of time before other companies have rights within that technology. It just hasn't been positive for drug companies. And what we've seen over the last 25 years is really they've tried to sustain themselves through consolidation. So companies have merged, which is really a cost-cutting effort. And they've been acquisitive of smaller technologies. So buying smaller drug companies and trying to grow that way. It's been a bit of a, leaky boat syndrome. You bail and bail and bail, but you're still sinking. So I would pass on Pfizer. You mentioned you like the dividend. I would caution that a lot of times companies have high dividends because they grow into them. In other words, their stock price falls, making their dividend yield higher. And that's not a great recipe for total return investing. So at Goodreid, we're a total return investor. We like dividends, but we like payout ratios to be reasonable, capital allocation plans to be constructive, and not just an alluring aspect of the stock. I noticed the stock, $25 on the chart we were looking at, down from 30. So, you don't say pay me to wait, because you're losing money out of one pocket, you're putting it in the other.
Right. There is Pfizer at $24.74. Okay, thank you for the question from Michelle in Miami. Let's go to Bruce in Simcoe, Ontario. Hi, Bruce.
Hello, and thank you for taking my call. My question's on BlackRock. It seems like it disappointed a few people today on its earnings. Like your opinion.
I was a little surprised that the market reacted as negatively as it did. I read a short synopsis provided through AI on the results, and it seems they lost a very large client in the quarter, which hurt them. But organically, they're growing. They grew at about 10% new money organically. They've made a couple of acquisitions, and they've front-loaded a few costs in that respect. But I think that the results were quite good, and I was surprised that the market was negative. So if anybody was thinking about buying BlackRock, certainly I wouldn't have any objections to them stepping in at this point.
Okay, there's BlackRock down 5.5% today. We'll be back with Gordon Reid of Goodreid Investment Counsel. He will resume once again taking your questions on U.S. stocks. Okay, let's keep the questions coming to Gordon Reid. Amin is in Ottawa. Amin, thank you so much for giving us a call. Always great to hear from you.
Good afternoon, gentlemen. I got Mr. Reid at the right time. I own JP Morgan, Citigroup, and Wells Fargo, and I'm a long-term investor, and 3 of my stocks are down. But I have a five or more year view, and I want to buy more. So what is your suggestion?
Good question. Of the 3 that reported today, we own 2 of them. We own JP Morgan and Citi. It's worked out for us today because Wells Fargo disappointed the street. I think that if you look at the net interest income numbers of the 3, they were the weakest for sure. And of the other 2, JP Morgan and Citi, you have a very clear compare and contrast. JP Morgan is the darling of the money center banks. It's the biggest, and I'd say it's the best. But on a valuation basis, it's completely different than Citi. JP Morgan trades at 2.2 times book value. Citi trades at 0.7 or 0.8 times book value. Citi has, been the whipping boy of Wall Street banks for, ever since the great financial crisis, probably, and maybe even a little before that. But they're getting their act in order. Jane Fraser, who's the CEO of Citi, has things straightened out. They've made changes. They're less exposed to international markets and the volatility that accompanies that. Their numbers are showing positive signs of direction, and they've done very well in terms of price appreciation because they're, being rewarded for good work, and the valuation differential is starting to narrow. So I'd say we own both, so we like both, but one is perhaps fully valued but continues to do good things, and the other has a slightly more risk associated with it, but more upside potential to bring that differential of valuation of the great and the not so great into line.
Okay, thanks for the question. I mean, that was a good one. Let's go to Frank in Mississauga. Hi, Frank.
Hey, thanks for taking my call. My question is for DRS. Gord, I believe this was one of your topics in the not so, I think few weeks ago or a few months ago when you came. Are you still constructive on this name? I know this is, I'm not sure if this falls into small/medium cap, and can this be a candidate to keep for 3, 4, 5 years to come, given all the changes that are happening in the geopolitics from the U.S. side?
Yeah. I think the answer is yes, Frank. We bought this stock a few months ago, and part of our thesis was that defense spending was going to increase as a percentage of budgets, not so much in the United States, but around the world. And we've heard, of course, talk in Canada and in Europe about the percentage of GDP that is allocated to defense spending. There's the arguments surrounding NATO and the contribution of non-U.S. Members of NATO being deficient, and they're stepping up under a lot of pressure. And that leads to spending money on companies like that are on products that companies like DRS produces. They're in, a bit of background for people who didn't hear me when I spoke a couple of months ago about it. This is originally an Italian company called Leonardo. They make propulsion systems for ships, and a few years back bought an Israeli company called Radar. Anyway. And in the radar business, and they together are getting more and more U.S. business because they have a U.S. presence. So it's a great story. It's not expensive in terms of valuation. We think that the spending on defense will increase worldwide. and we're a long-term holder.
Okay, we can't show a graph of that stock, unfortunately, but the stock has increased by 63% since early February. It's been all up since then, going from about $30 a share to about $47 per share. Thanks, Frank, for your call. And by the way, you and I chatted off camera about this. You usually talk about the biggest of the big stocks, but you also invest in small cap stocks on behalf of your clients. You've got a small cap fund, correct?
Correct. We've run the U.S. small cap fund or portfolio at Goodreid since 1992. Mm-hmm. Anybody who wants to look at how it's done, again, go to our website, Goodreid.com, to the performance page. You can see the performance of our balanced fund. There's a line there that says, look at all the composites, and you can see our U.S. small cap fund. I was bragging to Paul off camera that we had a fantastic second quarter. In US dollar terms, we were up 16.5% in the small cap fund. And we're very, very pleased with that. And of course, the mantra in the office is, well, that was yesterday. What can you do for me today and tomorrow?
Okay, and that stock, Leonardo, is in that small cap fund.
Yes, it is.
Let's go to Dave in Edmonton. Dave, thank you for waiting on the line. And you're up next on Market Call. What's your question to Gordon?
Thank you for having me on your show. It's going to be on United Health. And with the beautiful bill, how would that affect the upcoming earnings or future earnings of the healthcare industry?
Yeah. It's very confusing. What's happened over the last half dozen years in the U.S. healthcare insurance market has been tough because there's been a lot of gyrations, a lot of changes, most of them led by the pandemic and what happened to insurance during the pandemic. So just backing up a little bit, we've heard with the big, beautiful bill, the fact that they cut Medicaid and a lot of people in Medicaid are no longer going to be eligible. Part of that is because the enrollment in Medicaid grew dramatically over the COVID period because people lost jobs and they became eligible for Medicaid. Medicaid is intended to be the catch-all for people who are economically disenfranchised, the lower strata of the economic area in the United States. So the enrollment went from, say, 70 million to 90 million. And what happened with that was the incremental 20 million tended to be young, fairly healthy people. And what that does for insurance companies is it increases margins because there's not a lot of outlay of claims because they're insuring mostly healthy people. They just happen to have lost their jobs and become eligible for Medicaid. Those are the people that are now being cut off. So what's happening in terms of the insurance companies reporting earnings, and United Healthcare is one of them, is that their benefit cost ratios are gyrating all over the place. They're missing marks. The market's getting very nervous. We own a company called Elevance, which is a competitor to UNH. But unlike UNH, they have a big piece of their business that's in a fee-based commercial sector, which basically means that they don't have as much exposure to the gyrations of the insurance benefit cost ratios.
Okay. Dave, thank you for the question. That's the last of many questions to Gordon Reid today. Thanks to everybody who took the time to ask Gordon a question. Don't go away, however. Gordon Reid and his top picks are right after this break. Join us tomorrow on Market Call. Kim Bolton will be on the show. He's president and portfolio manager at Black Swan Dexteritas. He'll take your questions on, of course, tech stocks. That's tomorrow on Market Call. Well, it's time now for top picks. The first top pick from Gordon Reid today, a very familiar stock in the market, Apple, AAPL on the NASDAQ. Gordon.
We've held Apple on behalf of our clients for 2 decades, and it's been a very, very successful investment for them. But it takes time, lulls. And, people think often when you see a successful stock that it's just straight up. Well, it never really is when you look back at the charts. It's taking a break now, and it's taking that break on the back of people afraid that it's going to miss the AI revolution, that it's really not going to be involved. But I would suggest that if you look back at Apple's history, it's really been one of letting other people do the heavy lifting in the innovation stage. And then once things are established and the money has been spent, the big money, the failures have been made, that they then take it from second chapter on and they make it into their own. And I think that's possibly what Apple is going to do, maybe planning to do. One of the rumors out there is they might buy an AI firm. Perplexity is a stock that they've talked about, possibly in the $25 to $30 billion range if they pay a big premium. They've got that on the balance sheet. They could do that. They produce that in terms of operating cash flow every quarter. So it's not a big bite for Apple, but it would be a good opportunity. The market would react very positively to something like that.
Okay, something to watch. CrowdStrike is number 2, CRWD on the NASDAQ.
This is a bit of an anomaly for a Goodreid portfolio in as much as it really doesn't have a strong link to its fundamentals. It trades at a very, very high multiple. About a year ago, we decided that our U.S. large cap was large enough in terms of numbers of names that it could afford to have a company like CrowdStrike, which is a generational opportunity. It's a cybersecurity stock. This is a massively rapidly growing segment. They're the leader in that segment, and we thought, well, we either do it now or we don't do it, but let's manage it properly. So we bought in June of 2024 at, I believe it was $306 a share. And it did quite well in the first few weeks. And then some people might remember, some viewers might remember that in mid-July of last year, they had a software bug and the blue screen of death appeared across the world. And CrowdStrike got the blame for it, as they should have. But it was simply a glitch. The stock dropped precipitously down into the 230 range. We bought more. So we managed this along the way. It's moved back up into the high 400s. We just trimmed a little bit. We like the ownership, but we manage the ownership.
Okay, let's go to our final top pick of the day, MasTec, WTZ on the New York Stock Exchange.
An industrial in the infrastructure area, managing projects in the power grid, pipeline development. Growing rapidly. It's got an 18-month backlog against its revenue. Its backlog is growing. It grew 10% sequentially just last quarter to this quarter. We expect revenue growth is going to be very rapid over the next 5 years, and the stock isn't priced fully for that. Okay,
those are Gordon Reid's top picks: Apple, CrowdStrike, and MasTec, MTZ, on the TSX. Well, Gordon, I want to say this is the last time that you and I will share an anchor desk here at BNN Bloomberg. And I just want to thank you so much for all your appearances. Just like the viewers, I have learned a ton just by sitting here and listening to you talk stocks. And I've gotten to, of course, like you very much as a person as well. So thank you very much.
Thank you, Paul. And the same comes back to you. I've gotten to know you as, in a professional relationship, but also I feel as a friend. We've spent time some mornings at 7 o'clock in the morning, on the set, and we've had a lot of fun. I've enjoyed it. I've learned that you're as kind a person as you are a knowledgeable person, and I appreciate you very much, and I wish you all the best.
Thank you so much. And that's Market Call with Gordon Reid. Let's take a quick look at markets before we turn things over to trading day here on BNN Bloomberg. Here's a look at the North American markets, the S&P TSX Composite Index. down by about half a percentage point. It's been down for most of the day. The S&P 500 has now carved out a bit of negative momentum. It's been flat for most of the day, but down by a fifth of a percentage point. The strength is in the tech stocks, and not for the first time this year. The NASDAQ composite up by half a percentage point to 20,739 points, on track, if this persists, for another record high close. Here are a couple of stocks in the news, both companies major beneficiaries of the reversal by the White House on the ability of U.S. chip makers to sell certain chips to the Chinese market. NVIDIA pushes higher into record high territory. The market cap now $4.2 trillion on NVIDIA. And AMD, you'll see, is the next one. It is up by more. It's up by 6.25%. Both of those companies saying the White House has reversed its stand on particular chip sales to China. Here is a look at the S&P TSX Composite. We showed you in snapshot form. Here's the what the past year looks like on the S&P TSX Composite Index. Not far off from record high territory, and like many markets around the world, a spectacular rally since the early portion of April. Here is crude oil, and we'll wrap things up after crude oil. WTI trading at $66.33 at this moment. Thanks for watching Market Call. We'll see you next time. In the meantime, we'll turn things over to Trading Day right here on BNN Bloomberg.